Let's take stock then of the earnings season. We're now joined by Varun Lochab, the head of institutional research at HDFC Securities now. Varun, done with quite a bit of the earnings season. IT pretty much is out of the bag. Private sector lenders have all reported their numbers. We've got quite a few auto as well as cement numbers which have reported earnings so far. What has been your key takeaway, the top three takeaways, in fact, for you from this quarter?
Yeah, so a lot of the big sectors are through with the earnings. So banks and IT, which are the two largest sector in terms of Nifty weighting. Clearly, it's more or less a repeat of Q3, where banks have done the heavy lifting for overall, earnings season. So there have been upgrades for BFSI as a sector, which we have witnessed, which have been countered by downgrades in case of IT. So especially Infosys and Wipro, these are the two companies which have seen downgrades. So net, these two large sectors cancel out each other in terms of overall earnings. For some of the other sectors, things have been largely on expected lines. Say cement or steel, there has been sequential margin improvement as expected. But maybe the pace of margin improvement on a sequential basis is slightly slower than expected because I think the pricing power is still not back there fully because the demand environment wasn't very strong. So I think rightly so, companies have gone slightly slow on the pricing bit. And we believe, if we don't see any further input cost spike in the next 2 to 3 months, there will be further sequential earnings, and margin growth, which these companies will witness in the next few quarters. So I think net earnings season so far has been on expected lines. There have been no major upgrades or downgrades to FY24 estimates as of now for our coverage universe. But we are only, from a broader market perspective, only 35 to 40% of the stocks in our coverage have reported earnings. So we are yet to see the full impact. But qualitatively, it looks like a better quarter, compared to Q3 when there were more downgrades across multiple sectors. This time around, management commentaries are also slightly more optimistic on demand, and the recent rate pause by RBI has given a fresh impetus to some of the rate sensitives because otherwise there was a fear of demand destruction around the corner. So with that backdrop, we believe things can inch up incrementally from here on for next 3 to 6 months.
Varun, just to sort of expand on that point a bit, what has your read-through been for consumer companies, whether you're looking at discretionary or staples? Because we've heard very mixed sort of commentary from different folks. For instance, when Lever disappointed a bit on volume growth, Maruti sort of was hinting at some caution ahead in terms of retail appetite. We've heard Havells say the same thing. I mean, Havells is, again, there's just more seasonal business, perhaps because of the untimely rains. But whether it's Titan, all of these guys, Nestle had fantastic volumes for that matter. So what's your read-through on consumer?
Yeah, so consumer has been a very mixed bag and a very nuanced one, as you rightly said. If I look at Havells, I think it's more of the seasonal impact with summers not being as strong. So you will see some of the summer-centric categories will have that issue when the Q1 numbers come in. Overall, in terms of consumption demand, it's been largely sideways. So, our view has been that urban discretionary demand, while still fairly robust and resilient, but given the high base which we are lapping up now and which we'll do for next few quarters, you won't see optically very strong numbers from some of these consumer discretionary companies, be it apparel, footwear, QSR. While they will still be decent numbers, they won't be mind-blowing in that sense in terms of the YOY growth. Rural demand, which affects FMCG, we are seeing slight sequential uptick for sure. That's been there in most of the management commentaries that things are inching up, but it's at a very, I would say snail pace, or, it's not that there is a broad-based strong rural recovery which is underway. So things are incrementally looking better, but now all eyes are on monsoon and how that pans out. So net, I would say consumption, and which has been our call for last 6 to 12 months, that consumption is not looking to be the key driver for for the economy. It's clearly the cap goods, industrials, and if you see, the earnings story also out there has been much stronger and which has been rewarded by market also. Actually, the entire action is in capital goods, industrial names, manufacturing, and some of those pockets, cyclical sort of asset heavy companies rather than being in consumption or IT.
All right, got that. Varun, thanks a lot for joining us. The other space that, we have been discussing a lot on our shows is the entire real estate pack also, right? We had Godrej Properties also come out with its earnings, highest sales we've ever seen. Their collections are at the highest that we've seen. They're also saying that the launch pipeline for this year is above anything in the past as well. How do you look at these players in terms of what we can expect as a potential upside here?
Yeah, so real estate is again one of our preferred sector. When I said industrials, cyclicals, it included real estate. Clearly the sort of extended pause that we are expecting in terms of interest rates comes at the right time because otherwise the fear was that with continuously rising rates, demand would have gotten impacted for residential. Now with the pause coming in and the fact that affordability across cities is still at a multi-year high, we expect this residential upcycle to continue over next couple of years at least. And in that context, the stronger players, well-capitalized player in real estate are clearly preferred. Our top picks out there are, DLF, Oberoi, and Phoenix Mills. So I think overall, one should remain constructive on this space.
Varun, over the last couple of days, we've heard more bad news from the U.S. regional banks. So whether it's First Republic, yesterday we had PacWest seeing a fall of more than 50%. Incrementally, if we keep getting bad news from the United States and the regional banks there, should we be more worried about IT companies and what they're likely to report? Or do you think from the earnings picture that we've got so far in the commentary, we should not be too worried about bad news coming from the US regional banks because the exposure is not that high?
I think net now a lot of the negatives have got factored in terms of IT earnings as well. Our peer and the reason for staying underweight the sector for last 12 months was that earning expectation was still high while valuations had corrected. People had still not brought down the dollar revenue growth for FY24. Now, with Infosys sort of coming down and downgrading the guidance, now most of the analysts are building in 6 to 8% kind of a sector growth, which we believe these companies should still be able to do unless US economy sees a very sharp slowdown, which is not the base case scenario. So I'll not get overly worried on some of these, on the bank issue from IT perspective near term, but we need to keep a close eye. If this becomes a contagion and, this worsens US growth outlook for next, over next 3 to 4 months, I think is a critical period. The impact of these rate hikes, cumulative last 10 rate hikes will be felt, to full extent in the next 3 to 6 months across the US economy, including banks and consumption and labor market, and how things hold up out there would be interesting to see. But net our base case, we don't see further downgrades for IT sector from a demand side.
Oh, okay, got that. And I think the stocks are reflecting some of that, Varun, because the worst of the selling pressure seems to be done. In fact, at lower levels, we're seeing some accumulation in these stocks. Finally, before we let you go, just a quick call, your house view on Reliance Industries, considering that things are now moving in terms of carve out of different businesses, at least with the financial services businesses. All the approvals are in, and we're looking at, I think, September, October, when we'll have a separate entity, Geo Financial Services. Just in terms of valuing this entity or your current target price on Reliance itself, leave us with some thoughts.
Yeah, so Reliance, we have an ad rating as a house with a target price which offers around close to 10% upside from current levels. While structurally we believe it's a good move that it sort of carves out a separate entity for all the future businesses in financial services, and from a shareholder perspective, capital allocation decisions across multiple businesses, because now there is new energy, there is financial services, and the erstwhile, three large businesses, which is oil, geo, and retail. This sort of simplifies the corporate structure, and company could bring in professional management and independence in terms of running of each of these businesses. So longer term, it's a positive. Near term, we believe it will not change things materially, given initially only the the treasury shares will largely get valued, and some of the other businesses which will get created in terms of lending and insurance and broking, which they are talking about, over a longer period of time. The treasury shares are around 6% of our SOTP. Today, we were already valuing them in our some of the parts valuation of Reliance. They account around 1 lakh crore kind of a market cap. Yeah, that's the overall view. Structurally, I think it's a right decision from a minority shareholder perspective for the medium to long term. Near term, we don't see that to be the driver for share price out there. I think price hikes in geo and how retail business shapes up are far more important.
Okay, so those will be the key triggers to track for Reliance Industries. Thank you, Varun, for the conversation today. Appreciate you, stopping by and spending time.
Thank you.
We